Welcome to the Deep Dive. We cut through the noise of earnings calls to bring you, well, the essential insights. Today, we're looking at IBM's second quarter 2025 earnings. And really the big question for investors is this. Is this a genuine new chapter for IBM, driven by AI and hybrid cloud? Or is it just another upswing in the cycle? We're going to unpack their performance and figure out what it means for the wider tech world. All right, let's get straight to the numbers. IBM put a really solid Q2. They beat their own forecast pretty much across the board. What really jumps out from that initial snapshot?
Yeah, it's the breadth of the beat, really. They reported $17 billion in revenue, $4.7 billion in adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key profitability measure, and $3.2 billion in operating pre-tax income. Operating EPS hit $2.80. But look, the real headline, especially if you're thinking long term, has got to be that first half free cash flow, $4.8 billion. Right. That marks their highest first half free cash flow margin in years. That tells you something,
yeah.
Right? It signals resilience, sure, but also return to real effectiveness in how they run the business.
Highest first half free cash flow margin in years.
Yeah.
Yeah, that's a strong statement. It definitely paints a positive picture. But let's go beyond the headlines. Where did IBM really, shine? And what were the key drivers within the different parts of their business?
Well, the overall revenue growth came in strong, over 5% at constant currency, so taking out the FX noise. And this wasn't just like a blip. It was clearly driven by continued high demand in software and infrastructure. And those are the segments that really help clients boost productivity and innovate. So let's break down software first. Grew a healthy 8% overall. And their high-value annual recurring revenue ARR, that base is now $22.7 billion. That's up 10% year over year. And that ARR is just critical, right? It shows customers are sticking around, gives you predictable revenue. A huge highlight within that was Red Hat. It actually accelerated to 14% growth.
Wow, 14%.
Yeah. Think of Red Hat as kind of the backbone for hybrid cloud. It provides Linux, OpenShift, that's their big platform for containers, basically making it easy to run apps anywhere. OpenShift revenue itself grew more than 20%. It's got an ARR of $1.7 billion now.
Okay.
We also saw automation grow 14%. That got a significant boost from the HashiCorp acquisition.
Right, HashiCorp.
Exactly. They provide these critical tools for infrastructure automation. And it turns out they're a perfect fit with IBM's hybrid cloud stuff, helping clients deploy and manage complex setups faster. Data was up 7%, but here's a little nuance. Transaction processing actually saw a slight dip, down 2%.
Oh, interesting. Why was that?
It seems it was largely because clients were prioritizing spending on the mainframe hardware early in this new Z17 cycle. We'll probably talk more about that Z17.
Okay, so software sounds like it's really firing on all cylinders, especially with Red Hat and now HashiCorp in the mix. But you mentioned mainframe spending. That leads us nicely into infrastructure. Tell us about that.
Yeah, infrastructure was, frankly, a powerhouse this quarter, up a surprising 11%.
It's 11%.
11%. Hybrid infrastructure really stood out, climbing 19%. And that was largely thanks to a very, very strong start for their new Z17 mainframe program. That saw, get this, 67% growth.
67.
For mainframes, 67%. It's pretty significant. It tells us that even with all the talk about cloud, there's still this deep ongoing need for the kind of power, security, and reliability you get from a mainframe, especially for those mission critical jobs in finance, government, you name it.
Right.
Now, distributed infrastructure, that was down 17%, mostly product cycle stuff impacting power, but they did announce Power 11 in July, so, that could be one to watch for a turnaround. Okay.
And what about the third leg of the stool, consulting?
Consulting revenue was flat. Seems like it's stabilized through the first half. Now, overall signings were down 18%, but that was mainly due to some really big renewals last year that obviously don't repeat.
Right, tough compares.
Exactly. But what's encouraging is that their net new business penetration, that actually increased by 13% year over year. They added over 200 new clients. Their backlog is still healthy, up 4% year over year. And importantly, the duration of that backlog is down by 6 months.
Oh, what does that mean?
It suggests they're converting that backlog into actual revenue faster. So client engagement seems strong, even if those big renewal cycles make the new bookings number look a bit lumpy quarter to quarter.
Okay, that 67% mainframe growth, though, that really catches the eye. It feels like the mainframe just keeps reinventing itself. But let's connect this back to the bottom line. How did all this operational strength translate into profitability, and what are the strategic levers they're pulling?
Yeah, the profitability story is pretty compelling. They saw significant margin expansion pretty much everywhere you look. Operating gross profit margin up 230 basis points, adjusted EBITDA margin up 200 basis points, operating pre-tax margin up 110 basis points. And this wasn't just luck, right? It was primarily driven by these productivity initiatives they've got going. They're embedding AI across, I think it's over 70 of their own internal workflows now, optimizing supply chains. Basically, they're using their own IBM software to make themselves more efficient. And that leads to real cost savings, which drops straight to the bottom line as fatter margins.
Eating their own dog food, so to speak.
Exactly. And it validates their offerings, too. On cash flow and capital allocation, that $4.8 billion in first half free cash flow, a big chunk of that, about $1 billion year over year, came from that increase in adjusted EBITDA. They ended the quarter with a healthy $15.5 billion in cash. That's up $700 million from the end of last year, even after spending $7.8 billion on acquisitions, mostly HashiCorp.
Right.
And importantly for shareholders, they returned $3.1 billion in dividends in the first half. Shows commitment there.
So clearly they're not just growing the top line, they're doing it profitably. That's crucial for investors. But stepping back from the numbers, what are the core strategies driving IBM's innovation now? Where are they placing their biggest bets for the future?
Well, the strategy is still laser focused on two things: hybrid cloud and artificial intelligence. And what's really insightful, like we touched on, is they're not just selling AI, they're actively using it inside IBM. That validates their solutions, yeah, but it also gives them this unique perspective when advising clients.
Makes sense.
Their Gen AI book of business, this is the total value of generative AI deals since inception. It's now over $7.5 billion. And the momentum is accelerating each quarter. We're seeing strong demand for their AI agents, their assistants, their what they call real AI foundation models, the big underlying language models. And of course, this drives demand for their consulting services to actually deploy AI. In fact, their consulting generative AI book of business was over $1 billion just in this quarter.
$1 billion in one quarter for Gen AI consulting.
Yep. And it's now over 10% of their total consulting revenue. And here's the kicker. It carries about a 3-point higher margin.
Wow.
It really signals that shift, from just AI hype to actual AI implementation in big companies. And IBM's consulting lead suggests they're seen as a pragmatic partner, not just another tech vendor. That kind of de-risks their whole AI bet, I think.
Yeah, that's a really powerful point, moving from talk to actual projects. What specific AI offerings are getting traction?
Well, at their Think conference earlier this year, they rolled out some new stuff. WatsonX Orchestrate, for example. It lets users build custom AI agents without writing code. Comes with like 150 pre-built agents for HR, sales, IT, etc. Makes AI adoption easier for regular business users. They also expanded WatsonX data to help clients get value from unstructured data. All that text, audio, video lying around. And their Web Methods integration platform helps connect workflows in complex hybrid setups. And specifically for their mainframe clients, there's WatsonX Code Assistant for Z. It helps modernize old code, understand it, which is huge given how complex those systems are. And Watson Assistant for Z will act like an AI admin for the mainframe.
Got it. Lots of specific tools there.
Yeah, and they're backing it up with partnerships, deepening ties with Oracle, Box, AWS, Salesforce, Microsoft, EY, Finastra, WTP, you name it. The goal is always to embed WatsonX into core business workflows. And don't forget the infrastructure innovation, that Z17 mainframe. It's got the new Telum 2 processor. It can do over 450 billion AI inference operations a day, like right on the transaction data, millisecond latency.
So AI right on the mainframe itself.
It's exactly. No need to move sensitive data off platform for AI analysis. It's a big deal for certain industries. They also launched Power 11 in July for other critical workloads. Oh, and quantum computing. They hit a milestone deploying their quantum system 2 in Japan, the first one outside the US. Shows they're serious about leading globally there. And M&A is still key. They closed the DataStax deal this quarter, adds real-time scalable data tech for AI apps. And HashiCorp, as we said, already showing early wins and synergies.
Okay, so a deep bench of innovation, strategic acquisitions. It's a lot to take in, but it definitely paints a clear picture of their tech bets. Stepping back again, what does this all mean for the broader economy, and how are clients reacting to these shifts in the real world?
Well, one key takeaway from management's commentary was a definite shift towards optimism about the global macro picture.
Really? Despite everything?
Yeah, they pointed to specific things. Japan's reindustrialization and digitization efforts, booming South Asian economies, India growing at like 10-12% in real terms, The Middle East, Saudi and UAE especially, plowing profits into diversifying their economies with tech at the core. Europe, surprisingly resilient as a tech consumer. Why? Concerns over supply chains, cyber threats, labor demographics, technology is seen as an answer there.
Mm-hmm.
And in North America, companies seem convinced now that tech is the key to scaling revenue without huge capital spending or hiring costs. I was talking to a CIO just the other day, actually, and they put it perfectly. He said, we're not just buying tech anymore, we're buying solutions that prove their ROI almost immediately.
Right.
And that's exactly what IBM's Gen AI consulting seems to be tapping into.
That's a pretty positive global outlook, but are companies really opening their wallets, especially with ongoing uncertainty?
It seems so, but they're being strategic. Prioritizing cost-efficient, high-impact tech. You see banks using AI to improve customer experience, manage risk better. Telcos exploring software-defined networks for more flexibility. These aren't just nice-to-haves, they're seen as essential now.
Makes sense.
And Red Hat's position here is incredibly strong. Red Hat Linux is seeing high single-digit growth, partly just from being the foundation for AI deployments. And OpenShift is really emerging as a leader for containers, especially since, some competitors have basically backed out of that market, and virtualization costs from others, thinking VMware by Broadcom here, have shot up.
Ah, right. That whole situation.
Yeah. And the synergy with HashiCorp and Ansible for automation just makes Red Hat even stickier, more compelling. Now, regarding how AI specifically impacts spending, management made an interesting point. For hardware and the enabling software layers, that seems to be purely incremental investment. Companies are adding AI on top. When AI gets integrated into existing software products, it makes those products more competitive. So it drives market share gains rather than just cannibalizing older products.
Okay, so it's growing the pie, or at least IBM's slice of it.
Sort of. And in consulting, a big chunk of that AI book of business is actually a redirection of spending from other areas. Think less custom app development, more transformative AI projects. It's about optimizing existing budgets for higher impact.
Got it. Shifting priorities.
Exactly. Even in government, the U.S. federal government seems to be shifting from just cutting costs to actually modernizing agencies, using AI for better citizen services, reducing waste. IBM sees positive signs there, more engagement at high levels, serious intent.
That's a really fascinating insight into how AI spending is actually flowing. Okay, so looking ahead then. What's the outlook for the rest of 2025 and beyond? How confident is IBM feeling?
Well, given that strong first half, they're sticking to their expectation for accelerating revenue growth 5% plus for the full year. And importantly, they're raising their free cash flow guidance, now expecting above $13.5 billion for 2025. Again, that speaks volumes about their operational grip.
Raising guidance is always a good sign.
Definitely. And they've actually upped their target for productivity savings too, now aiming for about $4.5 billion in annual run rate savings by the end of 2025. That's up from $3.5 billion they hit in 2024. That's what's directly fueling the margin expansion. They now expect their full-year operating pre-tax margin to expand by about 1 full point. That focus on internal efficiency, it's a crucial lever for sustained profit growth.
Right.
Looking at the segments, software revenue is still expected to approach double digits. Red Hat in the mid-teens. Automation mid to high teens. Transaction processing, remember, soft in H1 due to hardware spend that's expected to return to low single-digit growth for the full year. But crucially, they expect it to benefit from that Z17 multiplier effect heading into 2026 and 2027.
The software tailwind from the hardware.
Precisely, where the hardware sales eventually drive, 3 to 4 times more software revenue over time. Infrastructure overall should add about 1.5 points to IBM's growth this year. They're being prudently cautious on consulting given the wider environment, but that growing backlog and the Gen AI momentum certainly offer some potential upside there.
Okay, it sounds like a confident outlook, but still disciplined, which makes me wonder, what's the hidden opportunity here? What might the market still be missing or underappreciating in the IBM story? All right, this is the part of the deep dive where we put on our outrageous but plausible trade idea hats. And just a reminder, of course, this is not financial advice. It's purely a thought experiment for, sophisticated investors. Given everything we've talked about, what's an actionable insight or maybe a what-if scenario that could unlock some value looking beyond the immediate headlines?
Okay, well, given those really strong initial Z17 mainframe sales, right, and how management kept emphasizing that 3 to 4 by Z-stack multiplier for software, particularly for transaction processing in the coming quarters. An interesting play starts to emerge. Remember, transaction processing was down 2% this quarter because clients were busy installing the hardware. But IBM explicitly projects it to reaccelerate into 2026, building on all that new mainframe capacity hitting the market. The market often just focuses on that initial hardware sale, right? They kind of overlook the long tail of high-margin software that follows.
Okay, so what's the idea?
The idea is this. Maybe consider a long position in IBM, but structured perhaps as a call option spread. And specifically target that reacceleration of the transaction processing segment in late 2025, maybe early 2026. You're essentially betting that the full impact of that Z17 software multiplier effect will kick in, something the market might be underappreciating right now while it's focused on Q2's hardware numbers.
Interesting. A bet on the software echo.
Exactly. And to potentially amplify this, you could maybe think about pairing it with a short position in a, let's say, legacy enterprise software provider, one that doesn't have IBM's integrated hardware software stack.
Okay, what?
The rationale is, as clients increasingly demand these efficient, integrated hybrid solutions, companies without that kind of captive high-value ecosystem like IBM has with the mainframe, they might face greater budget pressures. More reallocation away from them could make them ripe for underperformance relative to IBM unlocking that full stack value.
That's a fascinating, specific idea, really leveraging that software multiplier effect that often gets overlooked. All right, and that wraps up our deep dive into IBM's Q2 2025 earnings. We've definitely seen a company that seems confident in its strategy, leveraging hybrid cloud, AI, strong innovation cycles, driving durable growth, and importantly, significant cash flow. The question we started with was, is this truly a new chapter of sustained growth?
Well, from the accelerating Red Hat and HashiCorp synergies, that strong Z17 cycle kicking off, the rapidly expanding Gen AI book of business, IBM looks pretty well positioned to continue on this path. And their disciplined focus on productivity, those strategic acquisitions, it all reinforces their operational strength. It suggests they're not just growing, but doing it profitably with a clear eye on creating long-term value.
We certainly hope this deep dive gave you some valuable insights. If you have questions or want us to dig into other topics, please do reach out. Until next time, keep learning. And maybe ponder how often the biggest opportunities lie not just in the initial splash, but in understanding the long-term ripples like that software echo from a simple hardware sale. Stay well informed.